If I had to pick a single indicator for investors to focus on, it would be the monthly employment report that we get in both Canada and the US, usually the first or second Friday of a month. Well, I think the way to read the employment report is, what is the unemployment rate doing? Is it rising over a period of time, or is it falling over a period of time? And that will tend to give you a very good, simple, straightforward answer as to whether the economy is strengthening or weakening. The way interest rates affect economic growth is when they are falling, that usually tells you that growth is weakening and that policymakers are probably doing something to try to support growth and turn things around. But essentially, when interest rates are falling, that usually means the outlook for growth is weak in the months and quarters ahead. And on the flip side, when you've got interest rates starting to rise, that usually means it's being associated with a relatively healthy economy and things are actually expanding and growing. And if anything, policymakers are actually trying to cool the economy down by raising interest rates. The way the US and global economy more generally affect Canada, it's partly through trade and partly through commodity prices. I would say the US mostly affects us through the trade channel, and the rest of the globe mostly affects us through the commodity price channel. If we know what the US economy is doing, we've got 75% of the answer in terms of what the Canadian economy is doing. Whereas the other quarter is driven by Canadian policies, it's also driven by things like commodity prices, which is really driven by the strength of the global economy. The stock market does tend to act as a leading indicator for the economy broadly. It's not perfect. Sometimes it sends false signals. But generally, when the stock market is healthy and strong, it's a signal that the economy will be healthy and strong in the year ahead. I would say that if the equity market is sliding over a prolonged period of time, that is a real warning signal for the broader economy. I do think investors should pay a lot of attention to the economy. I think investors should pay attention to the direction of interest rates, but I think they should try to turn out a lot of the noise and trying to see where there are major shifts. Like, is there a fundamental shift in inflation? Is there a fundamental shift in interest rates? Is there a fundamental shift in the economy? Unless that's the case, then I really don't think it's that important for investors to try to follow every wiggle in the economy.